everyone, welcome back. You're watching The Money Show on ET Now. Time to talk about a topic that is something that's very, very relevant to each and every one of you, because you open your lockers, you talk to your parents, you talk to your grandparents, you open your bank lockers, and there is a little bit of it lying. I'm talking about gold and silver, whether it's in ornamental form, bullion form, coin form, brick form, or now, of course, even in paper form. There is some or the other exposure that every Indian has in gold and silver, and mercifully that's one asset class that's rallying. On the MCX, which is basically a noted commodity exchange in India, gold prices for the August futures crossed 50,000 and silver crossed 60,000 per kg. This is definitely a milestone, and yes, you may be wondering that hadn't gold crossed 50,000 earlier as well? Well, the difference was that was in the semi-organized, in the unorganized markets, including GST. This is on the exchanges, could consider it as a benchmark as well, but 50,000 on the cards. Now, you may be having several questions in your mind. Firstly, what can I do with the gold already lying with me? The question that may be occurring to some of you in your mind is this now a good time to perhaps sell off some jewelry, especially for those who are grappling with cash crunch problems during the lockdown? The second question, how can you really take part in this rally in gold, profit from it? Thirdly, with gold already being at such high levels, is it a good time to invest now? I'm sure these are just some of the questions in your mind, but let me add one more question. We always look at our portfolio in bits. So we say 60% or 70% in equity, and then another 25% in debt and 5% in gold. But given the fact that gold has rallied the way it has, the allocation towards gold has gone up tremendously. So maybe that could be a reason to cull off some exposure. Nevertheless, let me go across now to Mr. Lovaii Navlakhi of International Money Matters to get all of these questions and more answered. Mr. Navlakhi, thank you for joining us today on The Money Show. So first up, I'm sure you'll agree with me, it's an asset that's in every household, but how can they really take part in this rally, because I'm sure your advice is not going to be open your lockers, take out all the jewelry and, sell it in the market and enjoy the profit.
Yeah, and today, I think, Mubina, you don't even want to go to the market, so it's going to be difficult to do that. Yes, I think gold has certainly moved up, and so has silver, and people are at least have something to smile about. And all the questions that you mentioned are possibly things that are in minds of people. And I think that it is very important to understand what role gold plays in investment. And you mentioned that you could be holding gold in different forms, whether it's ornaments or bricks or paper. And I think each of those objectives are quite different. Typically in India, the ornamental gold is not really something that you want to trade on. It is meant to pass down. It's meant to, enjoy yourself or, celebrate something. So you're making something special. And that's very unlikely that you will use the ornamental gold to, encash. And of course, those of you who are active in that sort of market do know that if you sell the ornaments, you're losing the making charges. So you're already down to the extent of those making charges. So you may not want to do that. So that's one part of it. The part which is to do with the physical gold, the question really that one asks as a financial planner is, why did you purchase that in the first place? Was it, just tradition, and therefore you want to continue holding on to it? Or it is something that you kept adding on to it, every time there was a festival or an occasion to buy more. And maybe somebody, the older generation told you that it's a good and safe investment vehicle. So it could be that reason. Again, if those are the reasons, you're not really going to run off and say, okay, it's 50,000, per 10 grams. Let me go and sell off a little bit of it as well. But if you take the aspect of allocation, and those of you who've invested in it on account of your financial planner telling you having an allocation through ETF or through the sovereign gold bond or even through gold mutual fund, I think it's important to just look at the allocation and see what that allocation is And typically we don't get stuck with a single sort of rate. So when you mentioned say 5%, if just because it's become 5.5% doesn't mean that you sell off 10% of your gold. We would think that 5 to 7% is okay to have in gold at any point in time. In uncertain times, you can up it to maybe 7 to 10%. So look at that and look at the whole allocation before you determine what action you need to take. I think one very important thing about gold is the lack of volatility in its price over long periods of time. And I think that's very important to underline over long periods of time that the volatility is far less. It's meant to sort of hedge against inflation. But I have some data which maybe we can share as you ask some more questions, which might surprise viewers in terms of the sharp movements in the price of gold as well.
Okay, Mr. Navlakhi, what would you answer? I mean, would your data help answer those people who have a question lurking in their mind that gold has already rallied so much? I mean, gold funds today have delivered 30 and 40% returns in just the last 1 year. So should I now invest in gold funds? I mean, and like you mentioned, gold is not so volatile in the long term. So would you still advise that gold is a good investment even at these 50,000 odd levels, or even silver? Actually, now we should probably even club in silver here.
Yeah, so the small point on silver is that it's pretty much a speculative sort of investment because it's only available on the commodity exchange. You don't really get too much of a hedge. And for that reason, possibly is something that we don't normally advise our clients to allocate on silver because I don't have very easy ETF type of options available for silver. But I've got some data even on silver, and I was looking at past trends because we've seen this uncertain markets during the pandemic, and typically we have heard that when there is uncertainty, people sort of flock to gold, and gold prices do go up. So I was looking at prices sometime during the 2008 crisis, and I've done a little bit of study on both the dollar price, that is the gold dollar price per ounce internationally, as well as the gold rupee spot prices. And if I looked at October 2008, when the market was really at bottom, gold prices also incidentally fell by about 30% in the international market between February and October 2008. So while you might think, okay, in uncertain times, when the equity markets also fell by 50% during that time period, gold would have sort of hedged. It did hedge, it didn't fall as much, but they fell from about $1,000 an ounce to about $700 an ounce. Thereafter, in the next 4 years, that is till August 2012, gold rallied to $1,900 an ounce. And frankly, as we speak today, in the international market, gold has not yet touched $1,900. It's very close to it. It's probably $1,850 an ounce or so now. So it rapidly, ramped up and went to $1,900 an ounce in August 2012. And at that time, in 4 years, in less than 4 years, you had 170% rally in those prices. In rupee also, the gold rallied by about 155% in that period. So it felt fantastic, and you said, oh, and everybody was flocking to going on adding allocation to gold at that time. In the next 4 years, that is by December 16, in the international market, gold had fallen to $1,050 an ounce, 45% fall from the peak. And it has taken another 4 years now for it to go back to 1850. So actually, if I look from August 12 to July 20, the return on gold is zero. It's probably 0.5% negative return. And in the rupee prices, yes, in rupee terms, you did make about 7% return in this time period, but that's because the rupee depreciated by about 5% per annum during that time. So rupee went from 55 rupees toward the dollar in August 12 to about 75 in July 20, so about 40% depreciation. That's about 5% per annum. So I think one needs to keep in mind that if you go all in at one point in time, just following the more recent trend, you might burn your fingers. But the simple solution is look at gold from an allocation standpoint. Let's say you have only 2% of your assets in gold and you've missed this rally, so you've not made great money on the gold part. And your advisor is telling you, okay, let's increase it to at least 5%. My suggestion would be let's stagger and invest it. So look at the next 3 to 4 months and invest and bring up your allocation to 5%. And remember that you are investing in gold for allocation purposes to hedge against the portfolio, not because it's the best performing asset class in a recent period of time. So if I look at the current calendar year, gold is up by about 25%. Last year it was up 24%. So yes, it's a nice 50-55% rally in the last 1.5 years in gold. Um, and therefore, if you had 5%, say 1.5 years ago, you might be at 7.5%, or you might even be at 8 or 9% today because equity prices would have fallen a bit. So maybe if
Okay.
you think that you've made too much money, then yes, take off
All
some
right.
small percentage is what I would suggest.
Okay. All right. Okay, great. I think that was very comprehensive. Pick up gold only in pieces in a staggered manner, an SIP, if you will. Thank you so much, Mr. Navlakhi, for joining us today and just helping our viewers start off with that rally in gold. Use it as a hedge, not because price performance has been good. That's also a key advice coming in. With that, we're out of time. We'll wrap it up. Thanks for watching.